Okay, so we're on the next lesson. We're talking all about performance review. So as I said in the previous lesson, this is kind of part two to journaling, right? So in the previous lesson, we looked at journaling, which is just simple, create a simple log and file management, right? And just make sure you do it after every single trade. Okay, so performance review is a little bit different. It's the same. It's just an addition. It's part two to that lesson. So let's jump. I'm just gonna avoid the chatter a little bit and just kind of jump right into it. So I got my, little notes here for this lesson, a little bit to talk about there. But quote: "What you don't measure, you can't improve." It's very true. Very true. Regular performance reviews are crucial for refining your trading strategies. This lesson guides you through evaluating and enhancing your trading approach. We're going to be talking about the basic numbers: total profit, win rate, average win, average loss, profit factor, and expectancy. We're going to talk about the questions that you're going to be asking yourself during a performance review. Can this loss be avoided? Can this loss be smaller? Can this loss be a win? Can this win be a larger win? Frequency. How frequently do you do a performance review? And when to make changes? When do you actually change your trading plan or change your approach? Right? That. So let's go back to our spreadsheet. But before I do that, I guess, let's talk about the frequency a little bit. I don't think you should be doing a performance review at the end of every single trade. You should log it at that point. You should definitely log it, take the screenshot, and so on, right? But I don't think you should do a performance review at the end of the trade. Performance review is like you actually like looking at that trade itself and you're reflecting on it, not just the trade, but yourself, your performance, you know, what you did good, what you did bad, your errors, you know. So I think the best time to kind of like analyze the self and your performance is not necessarily just when you close that trade and your emotions are at a high or a low. You know, I think you need to kind of come out a performance review as kind of like part of a routine. You do this every single week or every month or every quarter or all of it. And you sit down for 2 hours that day and you look at a set of trades, not one trade, a set of trades, such as your trades from the week at the end of the week on a Saturday morning. You know, you can sit down on a Saturday morning instead of doing your watch list that hour when you would like do your watches or whatever. You can sit down on Saturday morning when you don't have to scan, when you're not doing a watch list. The only thing that you should do is journal, or not even journal, just performance review. You said because it should all be journals. So if you're doing like a weekly performance review, again, you would sit down on Saturday and just reflect on the week, both from the trade execution, trade management, trade idea. You know, you're obviously reflecting on that, but you're reflecting on your job. How did I execute it? How did I manage it? Was my performance top, or was I underperforming in my actions and what I was doing? You know, and a lot of times you'll find that a lot of trading performance, people will, when it comes to this performance review, and actually this is very important, you might want to like take some notes. um when it comes to performance review, a lot of times people just go straight to the charts and their trading plan, and I see people all the time changing and adjusting really good solid trading plans. You know, they like something goes is wrong. They feel that something is wrong, like because their performance shows it. And the performance shows that, hey, you're not profitable this month or this quarter. So that they go and first thing that they do is like they look at the trades and they'll be like, yeah, it's not profitable. So then they go and change the trading plan, the trading system, you know. They try a slightly different approach or whatever, and then a month passes and they'll notice, hey, I'm still not profitable, and then they'll change the trading plan again, and then a month passes and they're like, it's not that great either. Maybe break even, and then they change plan again, and now you're so far away from base plan that like you don't even know what the fuck you're doing, man. It's all over the place, you know. A lot of times it's not the trading plan. And what you'll notice is that the interesting thing is, like, I've done this, is here's another story. I do this almost every single year because at the end of the year, I think there's a different performance review that happens. So we're talking about frequency there. I think a weekly performance review is totally different than a monthly, totally different than a quarterly, totally different than an annual. But on an annual basis, you're like looking at the whole year, and you're like, how did I perform this year? Did I hit my goals? Did I hit my targets? And if you didn't, an annual performance review fucking sucks, because you're like, well, I didn't get any closer to my goals, you know? But the annual performance review cannot be your first performance review. If that's your first performance review and your only performance review is once a year at the end of every single year, I mean, you're going to miss your goal almost every single time. So from a frequency perspective, I think you really do need to kind of like do it weekly, monthly, quarterly, annually, all of it, um yeah, because you got to pick up on what's wrong and what's bad. But what I was going to say is that it's not just all in the charts. Most of it is actually human error and human performance. That's most of it. You'll notice that when I teach you this performance review system, when you do it at the end of a month or at the end of a quarter or at the end of the year, you're going to be like, oh shit, I should have made so much more profit, but I didn't because of this. That's what you'll notice every single time. And what you'll notice is, oh shit, this trading plan should have made so much more profit, but it didn't because of this. And those things are, but it didn't because I was sleeping and I mismanaged this trade and I messed out on 2R. It was running at 2R. It ended up being break even because I did not exit. Then you'll find 2 trades down, there'll be another trade. This trade should have been a +1, but it was a -1 because I was driving to work. And you go farther down and you're like, this trade was a -1, but it could have been 0, right? It shouldn't have been taken in the first place. It was a really bad idea, And then you go farther down and there's another trade. Oh shit, this trade was a 1R, but it could have been 2R win. I exited too late. I was greedy. And then you go farther down and you're like, oh, this trade was 0, but it should have been 1.2. I let profit disappear. And you'll notice it's things that you did or did not do. Right. And then you match it. Well, what should I have done? Well, I should have done this and this trade would have been 2. I should have done this and this trade would have been 1. I should have done this and this trade would have been break even instead of -1. I should have just followed the plan. And if I followed the plan, I would have made 20, 30, 40 or more than what I did. And I've done this. I've done this with traders at extreme levels at the end of the year. When you do this at the end of the year and you look at those numbers, what numbers you did hit and what numbers your trading plan should have hit, when you look at that comparison at the end of the year, it's ridiculous. And we're not even like gonna take into consideration missed trades, the trades that you should have taken that you did not take. But I've done this with a few traders, almost with everybody. Everybody should do it. But the traders I work with one-on-one, everybody kind of goes through this, and it always kind of comes back with like, I remember reviewing like one trader's performance. Like we just started working one-on-one together, and as part of the process, I always be like, okay, well, do your performance review. Let's see what's up, what's good, what's bad from prior to working together. And I'm like, do this. which is what I'm going to show you in a second. And trader came back, and it was like, and this is like every single trader almost. They come back, and it's like, well, I finished the year -8, but it should have been +62. Then I'm like, fuck, that's a big difference. You know, they finish up -8, but it shouldn't be +62. And this is like actually legit. It's true. You know, I had another trader who was like +5, but it should have been +40. And another trader who was like 0, but it should have been 70. You know, it's crazy. You know, it's crazy. And those numbers that should have been is always based on the plan. It's like I should have just done P1, I should have done P2, I should have done P3, I should have done P4. You know, this trade never had a trend change at entry, and I entered without a trend change. Should never been a trade. You know, this idea was crap. It was secondary. It shouldn't even have been taken. You know, and a lot of times you'll just come back with those kind of answers when you do a performance review, and you realize how important your performance is. And it's almost never about the market. It's almost never about the market. What the market did. Almost never. There's some cases where it's like, yeah, okay. But most of the time, the biggest kind of performance issues that we have is all things that we should have done that we did not do. You know, or we did not do correctly to the best of our ability. That we did not do it to the best of our ability. And that's what I was kind of saying in the previous lesson. That truth hurts. And most people don't want to face that truth because they're like, well, I suck. You know, I underperformed, and I know I underperformed, so I don't even want to look at this shit. You know, and it's like it starts a really bad spiral. So yeah, that's it for the story. So we mainly were talking about kind of like the frequency there. But let's look at our spreadsheet. One sec. All right. So we got the spreadsheet, right? What we're talking about, we were looking at it earlier. I want to zoom through it real quick. So I have a few things here that have been added on the side. This section is for performance review and only for performance review. Okay? This should be filled out every week, at latest every month. If you're swing trading, okay, quarterly. Okay? So it needs to be filled out. If you're like high frequency trader, you take a lot of trades, maybe you're day trading, it should be done every single week, you know, because you need to spot patterns very quickly. Otherwise, a good standard is monthly for everybody, monthly for day trading, monthly for swing trading. But day traders sometimes might feel, again, high frequency day traders might feel like they need to do this every single week. Great, do it every week. Because month, and the only reason why you would feel that is because when you do it at the end of the month, it's a lot of work. It takes a lot of time, you know, because you took a lot of trades or whatever. So if you feel like at the end of the month, it takes a lot of time, we'll do it weekly and every single week. Otherwise, do it monthly. And if you're swing trading, a lot of times maybe you only took like 3 trades in a month or 4 trades in a month. So I still think you should do it monthly, but you can do it quarterly. But I think monthly is just a good interval to do this. So you're just filling in this data, you know? So you're going for every single trade, you know, for every single trade, you're going and just filling this in. So what are you filling in? You're filling in a few extra columns here. So we got analysis, and I put higher time frame. And this is just simple. So when I talk about the higher time frame, it's this top left chart. You know, it's this top left chart. That's the higher time frame, right? Because this is the lower time frame, and that's like CBO, ABO, IBO. You know, that's kind of what you put in there. It's like the strategy, the analysis, right? CBO, ACB, WTF, IBO. Like that's the strategy, right? But the higher time frame is like, what's that higher time frame doing? And to me, it's just pull back or run, right? So this is in a pullback or it's in a run. I'm targeting a pullback or I'm targeting a run. So that's about it. Pullback or run. Target wave. Target wave. You don't need to do this. This is extra. I feel like it's nice to have, but this is extra. Target wave is like wave 1 breakout, wave 2 pullback, wave 3 run, wave 4 pullback, wave 5 run. Target wave. And this is which wave are you targeting actually catching, right? So targeting wave 2 run, wave 3 pullback, whatever it is. Oh, sorry, wave 2 pullback, wave 3 run. This is optional. I don't feel like you need to do this, but it's optional. Target level. Where's your target? S1, R1, or use Fibonacci. If you use Fibonacci, then like 0.618, 1.0, 1.72, whatever it is, 1.618, target level. Again, these two are optional. Target wave, target level, it's optional. Stop level, 0.618, 0.5, optional. Entry at 0.382 or 2-minute entry, 5-minute entry, optional. Exit, 2-minute exit, short-term aggressive or aggressive exit or long-term exit on a 15-minute. It's just like, what was your exit? You know? Or you can do like P1, P2, P3. These, I think, are optional. You can sometimes find value for them in large, when you're looking at a large set of data, right? You might find some interesting patterns, but these are optional. I don't think you need to necessarily fill these in if you don't want to, okay? What you do need to do, though, are these columns. Mistakes, observations, adjustments, adjusted status, adjusted return, difference. This is you need to do. This shit to the left, right here, even like analysis, higher time frame, this is all optional. These are kind of just like details to the trade. They're just kind of like details to the trade. I have my stop at 0.618. I have my target at this level. Started getting wave 3 run. Higher time frame was in a pullback. I entered at 0.382. I exited with phase 3. These are just kind of like details to the trade. Okay. But when it comes to performance review, it's this stuff, right? Mistakes. What kind of mistakes did I do? And this is like you have a trading plan. So mistakes are like things that are against the trading plan. So what kind of mistakes? I didn't do P2. I didn't do P1. I didn't do P3. I didn't do P4. I didn't do a fail-safe exit. Analysis was bad. No trade. Entry didn't have a trend change. No trade. You know what I mean? So it's like mistakes, things that you should have done that you did not do based on trading plan. And you're looking at the idea part of the system, the analysis part of the system, the execution system, the management system. You're mainly looking at those systems and you're like filling this in. But the main questions that you want to ask yourself in order to get those answers are the questions that I have listed here. I'm going to look at the basic numbers in a second, but the questions that I have listed, let's look at those for a second here. So you're going to ask yourself these questions for every single trade. Can this loss be avoided? Right? So can this loss be avoided? And you're looking at the mistakes column and the observations column, right? So I have an observations column here. Let me explain that for a second. So mistakes is like things that you should have done based on the plan. Okay. Observations are like, well, I did follow the plan. I didn't do any mistakes. I didn't do any errors, but I'm noticing something. There's an observation here, something that is not in my plan that I've noticed. Okay. This is like somewhat important, but this is like extremely important. Mistakes you need to identify. Observations, it's like, yeah, I follow my plan. Everything's good, but I didn't notice this. You know what I mean? It's that type of question. But going back to our questions here. So you want to ask yourself these questions for every single trade. Can this loss be avoided? Right? And now you're thinking like, okay, analysis, bad trade, good trade, right? It's a bad trade. Yes, this loss could have been avoided, right? Or can this loss be avoided? It was a -1, but you know what? It could have been 0 because I didn't do P2, you know? But mainly for that question, can this loss be avoided? It's just like, should I have taken this trade in the first place? Is this just a shit trade? It was just a shit trade, you know? Some mistake, bad trade. Trade shouldn't have been taken, bad idea. Question 2, can this loss be smaller? Maybe it was a -1, maybe it was a full loss. Well, could it have been partial, 0.5? Could it have been 0? Right? Can this loss be smaller? And a lot of times what I'll come back to is like, yeah, the loss was -1, but I could have done P1. I didn't do P1, or I didn't do P2. You know? Can this loss be a win? Same thing. Maybe it was a 0, right? Maybe you did do P2, but you could have exited for profit and you didn't. Yes. Or, can this loss be smaller? Maybe it was, again, sorry, wrong question. Can this loss be smaller? Maybe, again, you hit a -1 and it could have been 0.5, or you hit a 0.5 and it could have been 0, right? Just by doing P1, P2. Can this loss be a win? Question 3 is like, was a -1, or was a -0.5, or was a 0? Could that 0 be a win? It's like, yes, I could have done P3 and I didn't, or I could have done P4 and I didn't, you know? Can this win be a larger win? Maybe it was a +1, but it could have been a 2, right? So you ask yourself those questions and then you reflect on it as you're looking at the screenshot and you're thinking of the trading plan, right? And these answers should always come back to the trading plan. Can this loss be avoided? Yeah, it should have been no trade. It's a really bad idea. Can this loss be smaller? Yes, I should have done P1. Can this loss be a win? Yeah, I should have locked in profit, done P3, and I didn't. I let this shit go to break even. Can this win be a larger win? Yeah, I exited for 0.7, but I did an early exit, discretionary exit, and this actually should have been a 1.78 if I follow my plan, right? So you're always going to come back to the plan, right, with these questions. So what do you do with these answers? Well, the answers go in the mistakes, observations, adjustments column. So mistake is like, didn't do P3. Observations, none. Adjustments, do P3. Adjust the status, win. The trade becomes a win instead of a loss. Adjust the return. Am I screen sharing this? Yeah. Sometimes I don't see. Hold on. Adjust the return. Well, maybe it was a -1 and it should have been +1, because do P3. So it was a -1 or was a 0. So the status turns to win and adjust the return as 1. What's the difference? Well, if I took a -1 and then I banked a 2, well, the difference is 2. And the difference is between the actual profit when you're looking at the difference, right? So when you're looking at the win, it's like this trade was a win, but let's just assume this trade was a loss. If the trade was a loss, adjust the status, it's a win. Okay. Trade banked -1, adjust the return. It should have banked +1 if I did P3. What's the difference? The difference is 2, right? You do this for every single trade and you're going to notice, oh my God, I missed out on so much profit because I didn't do this stuff. That's performance review. So I'm not going to do this for you, but that's kind of how you do it. And this is kind of what you feel it is. So the mistakes, in simple terms, again, mistakes are things that you did not do that you should have done based on the trading plan. Okay. Could be anything from the management lessons, or it could be anything from the execution lesson, or anything from the idea generation lesson. Maybe this was a secondary opportunity and you should have taken the primary, but you didn't. You took the secondary trade. Error, and so on. So you collect this, and if you do this every single week, see, part of performance review when I talk about frequency weekly is you just fill this in every single week. I don't think you should be filling this at the end of the trade because you might be polarized a little bit. Emotions might be high and so on. So once the trade closes, chill out for a week. At the end of the week, fill it in, or at the end of the month, fill it in. And you might have a set of trades. One of these won't do anything. You know, you, part part of performance review, part one of performance review is just filling this in for every single trade. The goal is that we have as little adjustments as possible. The goal is like no adjustments. You did everything great, you know. But at the beginning, you might notice, hey, there's something almost with every single trade, and that's great. It's good. It's good to have that knowledge and that wisdom and that data, right? So part one is just kind of filling it in. Part two, and you do that again like at the end of every week or at the end of a month. But part two is when you have a lot of data filled in, when you have like 10, 20, 30, 40, 50 trades, right, filled in, and you're like, I achieved this, but it should have been that based on the adjusted return and the difference. I've achieved that, but it should have been much higher because of these mistakes, right? So that is when you like have a lot of data now after a month or at the end of the quarter. At the end of a quarter, that's kind of like when you should not necessarily be filling this in anymore. It should already be filled in at the end of every single month or at the end of the week. It should already be filled in, right? But at the end of the quarter, that's when you actually look at what the fuck you filled in and question it, right? You're not just questioning the trade at the end of the week or at the end of the month. You're just questioning the trade. How could this trade have been done better? Or what could have been avoided, you know, for this specific trade? So you do that at the end of the week or at the end of the month. But at the end of the quarter, you don't do this weekly or monthly. What you do at the end of the quarter is you look at everything, the whole data set, and you look at the difference and you're like, oh my God, it should have been 100 R difference, or it's a 50 R difference, or whatever it is. When you look at the difference and you're like, over a larger set of numbers, now you can actually look at the mistakes and be like, what are my similarities here? Where it's all human error. I should have done P3, I should have done P2, I should have done P1, I should have done P4. There should have been a fail safe. There shouldn't been a trade because there was no trend change. This was a bad idea. I was showering and I didn't do this. Like when you look at all this stuff at the end of the quarter and you realize all these mistakes were kind of human nature, human error, that is when kind of like true performance review happens, right? That is part two to performance review, because now you have all the wisdom and you look at that data set and you sit here and you reflect at it and you be like, okay, well, next quarter I got to make sure that I do all this stuff, because not doing this stuff costed me 20R, 30R, 50R, 100R, whatever it is, 10R, 5R, even like 2R extra is a big deal. You know, you don't realize like maybe you did good, maybe you did really good. You know, this isn't just for shit traders. If you're not doing well, maybe you did really good. Maybe you hit like 8R for the month. Maybe you hit 8R for the month. But when you do this performance review, you realize, fuck, I could have been at 14R. Well, small, it seems like a small difference, but add that up every single month, even for a profitable trader, somebody who's hitting 5R, 6R, 7R, 8R, 4R every single month, when they look at this and they do this and they look at it at the end of the quarter and they're like, yeah, I did good. I did 30R this quarter, but it should have been 50. It's like a punch in the gut, and it needs to be. I'm serious. It needs to be, because it needs to be like a jaw drop type of moment of like, what the fuck? You need to tell yourself like, what the fuck? What the fuck just happened? You know? And you got to make sure that next quarter you don't have any errors. Or at least less, so that you maximize every single trade. The goal is that at the end of the quarter, at the end of the month, there's nothing. There's nothing. There's nothing. It's all good, which was kind of the story that I mentioned at the start of the journaling lesson. I'm like, I had a journal submitted. I sent it back to the guy, told him to review it and give me his notes. He sent it back. He was like, everything's good. And I look at it and I'm like, just like, everything's wrong, you know? So part of the performance review is like, you got to be honest with yourself. You got to actually make sure that you identify the errors. You're honest with yourself. Don't hide behind the shit. Just be honest, write it down so you know exactly what the fuck is up. Because a lot of it is human performance, like things that I could have done that I didn't. Majority of it is like that, and that is easily fixable. It's just people avoid it, and I'm just stressing this point because I think it's so fucking important, right? Don't avoid it. Don't avoid it. But the goal is that at the end of the quarter, there's no changes. That's the goal. And when does that happen? Is when you have done everything, when you've done your best every single time. That's it, you know? So, yeah, like this is all good and it's important to do this, extremely important to do this. But the goal is not having to do this because it's just like it's doing it, but not filling it in because there's nothing to fill in. It's all good. I've done everything as I should have done based on the trading plan. You might have some observations, that's cool, right? But you have done everything based on the trading plan and there's like nothing. The goal is that there's fucking nothing. But actually, like, true, you were honest with yourself and there's actually fucking nothing, you know? Not, and you were not false. You're not like saying there's nothing and there's actually a bunch of shit. You actually like looked at it and you were honest and you're like, no, I've done everything great. And the numbers should speak for it. If you've done everything great, the numbers should be great. But if the numbers are not great, chances, and you're saying you've done everything great, there's a misalignment there. It's not aligned. There's something off. There needs to be something off, and you need to fucking find it. You need to identify it. All your attention should go not to trading, it should be to fucking solving this problem. I'm serious. A lot of people just go into drawdown, big drawdown, because they're like, oh, just next trade is going to win, next trade is going to win, next trade is going to win. And all of a sudden, they're just in this big drawdown and they like just been doing a major error every single time and they just like been avoiding it. You don't want to get to that point, right? You just want to do your best every single time, right? But your first year, there will be mistakes and there should be, your year 2, year 3, year 5, there will probably still be mistakes, you know but the goal is to be profitable. And the errors, if I fine tune the errors, I'm even more profitable. That's the goal. The goal is that you're making money, right? And there's just small little tweaks here and there that make you a little bit more profitable. That's the goal, right? So that's kind of it. It's kind of it for this, right? Do your own performance review. You need to kind of find your own flow with this, but again, like do it every single month, not weekly. Weekly, just like, I mean, you can fill it in weekly. You can fill it in weekly for sure. Just fill it in weekly, or monthly. But once a quarter, you look at this data and you actually like reflect on your performance. Once a quarter, filling it in is just like filling it in on a trade by trade basis, and that's why I say like you do that every single week or every month. But at the end of the quarter, and specifically at the end of the year, both at the end of the quarter and at the end of the year, you're not looking at it as a trade by trade basis because you've already done that. You're looking at the whole set, all of the trades, the whole performance review, and you now are going to have like bunch of data and you're going to look at the difference and you're like, fuck, I've done this, but it should have been that, that's kind of what you do at the end of the quarter and at the end of the year. And that is when you make changes. Number 4, when to make changes, that at the end of the quarter and specifically at the end of the year is when you look at the data set and you're like, I should have made so much more and I've been repeating this error over and over and over again. Well, when you're starting your next quarterly sprint, you got to act best. You can't do the same mistakes over and over and over again. Those mistakes need to stop. You cannot be repeating mistakes every month, every quarter, every year. Do them once, do them twice, but then they got to stop. you know, and the only time they will stop is when you actually do this process and you realize, oh shit, I am making mistakes, and these mistakes are costing me a shit ton. That, you know, and I guarantee you, it is almost never a market problem. It's almost never a market problem because, like I said, market conditions, it's your whole job is to analyze market conditions and deal with it and have rules and systems in place, and we do. The trading system is all in place to deal with market conditions, right? But we are the ones executing it, right? What else do I want to talk about this lesson? Performance review is so important. But I think I covered all the major things. Oh yeah, there was one more thing that I did not cover, which is like the numbers, right? Total profit, win rate, average win, average loss, profit factor, expectancy. These are all just subtraction, division, multiplication, you know? Um, so where do these numbers go? They're right here. So I have this other table set up, and again, I want you to fill this in. Now this table, the way it's set up, let me just do something. Yeah, this table, the way it's set up, is very important. Very important. So I have the main kind of data sets. So like starting balance, if you add some deposits, if you do some withdrawals, you can just put this in. This isn't required. It's maybe a nice to have, but it's not required. Okay. Starting balance, deposits, withdrawals every single month. But I have these are required. Total profit in percentage, total profit and loss in dollar amount. Let me make this larger. Yeah, so total profit in percentage, total profit in dollar amount, total profit in R multiple, and then the rest we're mainly going to track in R multiple. Winning total, R multiple, losing total in R multiple, largest win in R multiple, largest loss in R multiple, average win in R multiple, average loss in R multiple, profit factor in R multiple, total trades, winning trades, losing trades, win ratio, average duration, trade expectancy. Where do you get these numbers? You get them all from the log. They're all here. You know, so total P1, total profit in percentage, dollar, or R. Well, it's right here. Total profit for the month, you know, selected for the month or whatever. And it's like $8,778, you know, total profit in percentage, total profit in R for that period, whether it's a month or a quarter or a year that you're selecting. You know, it's all here, right? So you just select it and fill it in. Total profit percentage, dollar, R. And you just fill it in every single month. And then at the end of the quarter, you just kind of like add it up, you know? Pretty straightforward. Same with like winning total, losing total, right? For that month, I mean, it's very simple. You just like select all the wins and all the losses, you know? So what's the winning total? You just select all the wins, you know, for that period of time, you know, all the wins, and then select the losses. And winning total goes in there and losing total goes in there. Largest win, largest loss. Well, again, you can just find it there. What's your largest win? You will see it, 3R. What's your largest loss? Well, it's this one. You know what I mean? And then profit, average win, average loss. Again, that's pretty straightforward. You select all your wins and for that period, and you will get an average right here on the bottom. You know, you can just calculate it yourself, or just the average just pops up. So average win, average loss, do the same thing for the loss. And profit factor is a simple calculation. I want you guys to use AI for this, ChatGPT or whatever AI you use, but use AI and just search it. You can even run this, take a screenshot or paste this spreadsheet, paste this log to AI and have them do a whole analysis for you, you know. Use AI for this stuff. It's great. But this is just simple subtraction calculation. Profit factor is a very simple formula. Yeah, you select your total profit, you select your total loss, and you do a division. It's just right here, total, yeah, winning total, losing total, and do a division. Then you get your profit factor in a ratio. Um, Total trades, how many trades you've taken that month, how many were winners, how many were losers, and that will give you the win ratio, you know? And then average duration, that's already set up based on our hold time. You select your hold time and you will get your average duration. So, like I said, all of it is just from the spreadsheet. And trade expectancy is still a simple formula. Um, it just looks at your average win, average loss, and your win ratio. It just looks at these three factors: average win, average loss, win ratio. It's a very simple formula. You can just Google it or ask AI again. Um, and it spits out the trade expectancy. What does that mean? Well, it's based on your results, how much you should expect from each trade. And yeah, pretty straightforward. And yeah, and you fill it in like this every single month, and then you have your January, February, March results, and then you just add it all up for the quarterly result, and then you do it again for April, May, June, and you add it up for Q2, and you do it for July, August, September, and you add it up for Q3. I found that this structure is the best way to organize your data like this, exactly like this. And then you do October, November, December, and you have your Q4, and then you add it all up for year to date, the entire year. And you do this for every single year. And you have a nice little table of all your most important data. Um, yeah, you can do a little profit curve if you want, which this is just, a selection of your total column. Then all of a sudden you get a nice profit curve. That's what I mean. It's just like keeping a simple spreadsheet, I find is just the best. Um, I do want to, since I'm here to wrap up this lesson, make it a little bit interesting. I do want to kind of show you whenever you have a question about any of these numbers, um, just hit me up and ask in Slack or ask in the community or ask in a live webinar, and I can help you with the performance review. This kind of gives you everything to kind of do it by yourself. If you ever have any questions or you want a deeper insight, just feel free to ask in a session or ask in Slack. But what I wanted to say is I want to show you the effect on risk percentage. All right. So remember we were talking about scaling lesson, right? 1% risk, 2% risk, 3% risk, 4% risk, 5% risk. I want to just touch on this a little bit since I have the log here, and what kind of difference higher risk makes. So you see, I was saying in the journaling lesson, I started this with 10, like this journal, this example, this is an example. I just set this to 10K, because that's the first goal is to grow $10,000 account to 100K and 2 million and to 10 million, right? So it starts with 10K. For some, it might start with $1,000, but I just wanted a lot of people are going to start somewhere around 10K. And I have the risk percentage here. And I can change this so that if I change it to 1% and, just drag that 1% for every single trade, there's 100 trades here. It gives me a total. 10,000 over these 100 trades. These are actually live trades I've taken over the last 12 months. So if they're all at a 1% risk, I would have a 100% return, roughly 17K profit. Compounded. It's 100% return, not compounded, 17K profit, 170% return compounded. Decent. It was really good, actually. 170% return is fucking amazing. It's actually really, really good. It's really good, right? This is like extremely good to take a $10,000 account and turn into almost 30 grand over 100 trades. Like it's really good. I'm not gonna lie, it's really good. But this was at 1% risk, right? So 100 trades at 1% risk gives roughly 17K. But 100 trades at 3% risk it gives you 180 grand profit, not 17, 180. This is a 3% risk. These are the same, and this is something that I wanted to stress. It's like, sorry, it's the same trades. It's the same effort. It's the same amount of time that you're in the trade. The only thing that changes is how much you're risking per trade. And that's why I say you got to start with 1% and you got to build yourself there because you can't start with 3 or 4 or 5. You'll blow your account. You got to start low, but you want to get yourself to full risk because it's a big fucking difference. If you take 100 trades at 1%, it's 17K. But if you take 100 trades at 3%, it's 180. And if you take 100 trades at 5%, which is kind of the max. I risk 5%, and I recommend to a lot of people who are full time and doing well because it's a major hack. Same amount of trades, 1.25 million. So you can have two traders, one trader who is taking the exact same position, entering at the same time, exiting at the same time, but they're risking 1%. And you have the second trader who is taking the exact same trades, entering at the same time, exiting at the same time, but they're risking 5%. The 1% trader makes $17,000 with the same effort, the same performance, great performance, right? But the trader who was just risking more made 1.25 million, not 17K, 1.25 million. That's the power of compounding and increasing your risk. You know what I mean? Now, you might start off risking 1%. This is kind of like your scaling plan might be risk 1%, till for 10 trades, right? Or 1% till you make 10R. Where's 10R? 1% till you make 10R, which is right here. That's exactly 10R. So this is a scaling plan. This is how it should work. You start with 1% till you make 10R. Cool. Then you up your risk. Then it's 2% till you make the next 10R. Right here. So that's 2%. Then you do 3% till you make your next 10R. Just do it there. This took a while here. So that'll be 4, or let's just jump to 3%, right? Well, let's double it. Let's just let's jump to 3. Let's just keep it in order. Roughly down to there, and then you do 4% for your next 10R, which is roughly right there. And then the rest stays at 5%. The whole rest stays at 5%. You scaled, the rest is 5%. And this is how you do a scaling plan, right? And this is the best way to do it. So you start 1% risk, 1% till you hit 10R profit. Once you hit 10R profit, you increase your risk to 2%. Then you go 2% till you hit another 10R profit. Now it's all at 2%. Then you go 3% till you hit another 10R profit, and this took a little bit longer, And then you go 4% till you hit another 10R profit, and now you've scaled fully, and now you're at full 5%. And this is the best way to get started, in my opinion, with scaling risk. And now it's 470 grand versus, again, just 17K. Obviously, if you were risking 5% the whole time, it's 1.2 million, right? But that's what your next year is going to be, right? Don't rush this shit. Because if you start risking 5% right off the bat, and you don't know what the fuck you're doing, you have a very high chance of blowing your account. very high chance. So you want to do the scaling process. You want to make some profit, you know, and this way you already made like you know, 17K profit before you start risking 5%. And so you're already profitable. You already pulled some profit. So that's how you increase risk. But that's also the power of increasing risk. And when I was kind of saying at the start of this masterclass that, you know, most traders in this industry will say never risk more than 1%, right? It's like, yes, it's true. You shouldn't as a beginner, you know, but once you're learned the stuff, but mainly once you're profitable, that's why like this scaling plan is only based on profit. You only scale when you hit profit. You only scale when you hit 10R, you know, and every time you hit 10R, you increase. If you don't hit 10R, you're not increasing, you know. And you go the opposite. If you have minus 10R, like you scaling down, you know. So it's like this is the proper way of doing it. And the goal is like to get full scale by the end of the quarter. It can be faster. It can be 1% to 3% to 5%. It doesn't have to be 1%, 2%, 3%, 4%, 5%. I think that's the safer way of doing it. It's just 1%, 2%, 3%, 4%, 5%. I think that's a safe way. And you still make a lot of money, but then when you're at full scale, that's when profit kicks in, you know, truly. But this is why I say it's like, yes, you want to start risking 1%, but you want to increase that risk if you want to maximize return. You know, this is how you have good traders who don't make much money is because of risk. And then you have good traders who make a shit ton of money. It's all because of risk. It really is. Those traders who are living a good life, you know, living in nice houses and just doing well, risk. Increase risk. And all of a sudden your time becomes 5 times more valuable. 1% versus 5%. That's it. Before you increase risk, you gotta have to do performance reviews first and make sure you're actually profitable. So that's the point of this lesson, performance review. I hope they all make sense. Went a little bit longer in these lessons, but again, it's all important. Performance reviews need to be done. Remember, once a week, once a month, you just kind of do a performance review for each trade, but then once a quarter, once a year, you do a performance review for the whole thing, you know? And that is when you make changes. You don't make changes week to week, month to month. You make changes at the end of the quarter and at the end of the year. You know, and a lot of times it's going to be performance related changes, day-to-day changes, habit changes, routine changes. That don't be like, I need to add a rule, I need to add a trend line rule. That's often not the best changes. So that is it for this lesson. Hope you enjoyed it. See you in the next one. Bye-bye.